Connect MKE is sponsored by U.S. Bank.
Americans looking for some financial relief may find a little bit of help from the actions of the Federal Reserve, which sets the interest rates that impact us all. Congress charges the Fed with keeping inflation down and employment up. It uses the federal fund rate, the interest rates banks charge to borrow money from each other, as part of this delicate balancing act. Recently, the Federal Reserve has cut these interest rates twice, and there is speculation that more cuts are on the horizon. Here to help us understand how that impacts all of us and our money is Nina Johnson. She is the Senior Vice President, Wisconsin Branch Banking Market Leader for U.S. Bank. Thanks so much for being with us. We appreciate it.
Absolutely. Good morning, Denise. Always an honor to be here.
We're happy to have you. So let's get a basic understanding. How do the Fed interest rates impact people in their day-to-day lives?
Well, you said it so nicely in your intro. When we think about the Fed fund rate itself, it has a series of characteristics that supports how the consumer spends money, because it's based on how, you said it, banks lend to each other. But that's not the base rate that consumers will see. The base rate that they see is actually contingent on a couple different factors, and those factors impact credit card spend, personal loan spending, different variables that help the economy continue to grow. So without going into economic policy, let's take a step back just to understand how important the Fed fund rate is. When we think about inflation, unemployment, economic growth, and things that could potentially help us in our day-to-day activities, we note that the Fed fund rate has an impact on everything that consumers do each day when they're trying to spend wisely. So I'm looking forward to having today's conversation, just because the Fed fund rate, it is kind of the backdrop of our economy.
When the Fed lowers interest rates, everybody goes, yay, this is good news, because it's going to cost less money to borrow. But there is the flip side to that. What impact does it have on savings, especially when we look at high yield or high interest saving accounts or certificates of deposit, CDs?
Thank you for asking that question, because to your point, when the rates decrease, we assume that that's going to affect every rate, and it doesn't. When rates decrease, and let's go back a couple years, in fact, as an example, the interest rates were approximately 0.75% for CDs and money markets. So your savings growth was a little bit more restrictive than it is right now, just because you fast forward to today, those same interest rates are at 4%. So when you look at it on the savings side, the fluctuation of that interest rate has a significant impact on savings. Now, turning the page over to the lending side, where we talk about the credit cards and the personal loans, as well as some of the other products that are available on the lending side of things, when you see the rates decrease, that means that you're getting a better rate on your credit card and potentially your auto loan. For example, auto loans a couple years ago were slightly, higher than they are right now, because the Fed fund rate was fluctuating at that point in time. So when you think about the decrease in your Fed fund rate, and you know that has an impact on your auto loan, you would imagine right now is a busy time in the auto industry, because people are seeing that Fed fund rate decrease, which means that their auto loan payment, their auto loan rate decreases concurrently.
And it really is interesting how, when we talk about that short-term borrowing, we can see almost an immediate impact with rates being lower. It's cheaper to borrow money. So people tend to spend a little more money.
It's tempting, but the one thing I would say, as we're talking about savings, is you should definitely talk to your banker about what strategic way you can maximize your dollar, because the rates decreasing is a great thing, but does that mean you have to spend everything you save? Not so much. You can actually take that savings and put that into a CD or money market fund to let that grow for you while you continue to pay on that low interest rate auto loan or that that new credit card. So there's a way that you can really maximize both aspects of the interest rate. You just want to make sure your banker at US Bank, of course, is involved with the process.
And it is a good time. We've talked about this, that even when you think things may be looking up in terms of interest rates, you still want to talk to your banker, because there just may be options, whether it comes to borrowing or saving, that you're just not aware of.
Absolutely. That's such a key component of, just managing your money wisely and being strategic on how you save and also use a dollar.
One other thing we'd like to talk about is that impact that higher interest rates have really had when it comes to people who want to make probably the major purchase that most folks make in their lifetimes, and that is buying a home. How does this lower rate impact the mortgage rates that banks charge for home loans?
That's a good question. And I do think it's important that people understand, first off, that mortgage loan officers are readily available. I know they're at our US Bank branches ready to talk to customers, because we don't want people to be misinformed. When the Fed fund reduces rate, that does not have a direct impact on your conforming mortgage, or your first mortgage, or your purchase, or your refi, whatever you want to call it. It does not have a direct impact on that, because the mortgage industry is based on the bond market and the 10-year treasury yield. Those are the two key components that impact your mortgage rate, separate from the Fed Reserve prime rate, what we just talked about. Those are two separate indicators and price components when you're building your mortgage plan. So when you think about somebody who wants to purchase or refi their mortgage, they really need to talk to their mortgage loan officer for one reason specifically that I want to talk about. And you've probably not heard this term, I would say, on a regular show, because people don't really talk about it as much, but it's called your strike rate. Your strike rate is the rate that you can afford based on your financial capabilities. And this is what your mortgage loan officer will talk to you about. For example, and we'll just talk about refis, just because so many people secured a very low interest rate mortgage shortly after the pandemic, that they may not need to buy another home, but they want to look at refinancing. In that case, if they want to refinance, the strike rate is going to compare the current rate that would be charged for the mortgage versus the rate that they paid when they actually secured their mortgage years ago. The difference between that and also the tenure of how long they plan to stay in the home helps to determine whether or not it's a good idea to refinance. So there's a formula that's used to determine whether or not somebody should really refinance their home. The strike rate is also used when you're trying to purchase a house. So just note that that's a formula. That's a system that mortgage loan officers, no matter where you go, they're using that to help the borrower understand whether or not they can really afford to secure a new mortgage loan with their banker or credit union.
It's interesting when you talk about the strike rate, and thank you for explaining that to us. Most people just think, okay, I locked in maybe at 6.75%, right? And now I see that the Fed is lowering rates, so now is the time for me to refi. It's not always that simple, and you have to look at what both the short-term cost and the long-term cost, because you do have to pay to refi.
You absolutely have to pay to refi, and you don't want to pay too much to do so. The other thing about just going back to the Fed fund rate that people may not realize is, when banks are trying to secure the best product for you, there's an opportunity to have a better rate just by having a relationship with that bank or credit union in advance. So by having a long-term relationship with the organization, you've built a relationship with them. They know who you are, and now they can kind of direct you to the appropriate departments to support you for the full aspect of what your financial needs really are, and not just a one and done kind of approach to, okay, I'm going to help them with their mortgage today, and that's all. It's not that when you're talking about your finances, and we definitely as bankers want to make sure that you're fiscally sound across the board.
As always, this is really good information for us to have, especially for people who may have been sitting on the sidelines, kind of waiting to see what was going to happen with interest rates before making major purchases. We really do appreciate it, Nina. Thank you so much for being
Thank
here.
you. It's been an honor.
And if you want more information or you have more questions, you can check in with your local U.S. Bank branch. We're right back.